So what is Forex trading and can it make you rich? Forex trading is the buying and selling of currency pairs on the foreign exchange markets. When you are trading Forex, you are exchanging one currency for the other. The foreign exchange market is highly liquid, with a daily trading volume of a staggering $5 trillion. The currency pairs with the highest trading volume are displayed on your screen now. As you can see, we have the euro dollar, the dollar yen, the pound dollar, the dollar franc, the Aussie dollar, US dollar, the US dollar Canadian dollar, and finally the Kiwi US dollar or the New Zealand dollar US dollar. So if we take euro US dollar as an example, the first currency in the pair is called the base currency and the second the quote currency. So the euro is the base currency and the US dollar is the quote currency. In this case, the symbol euro US dollar is giving you the price of €1 in US dollars. When you trade Forex, you can either place a buy or a sell trade. If you buy a currency pair, you believe the base currency, the first currency in the pair, is going to increase in value relative to the quote currency, the second currency in the pair. If you sell a currency pair, you believe the base currency is going to decrease in value relative to the quote currency. So let's take an example. If you place a buy trade on the euro US dollar, this would mean you are buying euros with US dollars, with the hope that euros will go up in price so that you can sell them for more US dollars in the future. If you place a sell trade on the euro US dollar, you are hoping the value of the euros goes down relative to the US dollar. Now, selling is slightly different because you do not technically own any euros, so you don't have any to sell. In finance, this is called shorting. The act of shorting is extremely simple. You ask someone to borrow the euros, sell them immediately in the market, pocketing the value of the transaction at market price. You then still owe these euros back to the person you borrowed them from, therefore you must return them at some later date. So, when you place a sell trade on the euro US dollar, you're effectively borrowing euros, selling them immediately in the market, and then hoping the price goes down so you can buy them back at a lower price, giving the euros that you owe back to the person you borrowed them from and pocketing the difference. However, online Forex brokers simply do this for you, so all you need to know is that when you place a sell trade on the euro US dollar, this simply means you think the price of euros is going to decrease relative to the US dollar. So there are two important things when Forex trading. There's both leverage and margin. Firstly, leverage. This is what makes people so interested in Forex trading, and it's extremely powerful. So the power of Forex trading is that you can use leverage on your trades. In finance, leverage simply means that you're using someone else's money on top of your own money to amplify the returns or losses. Most online Forex brokers will offer up to 30-to-1 leverage on your trades. This means that if you have £200 and you wanted to buy a Euro USD currency pair, the Forex broker will give you 30 times your money on top of that to leverage up your trade. So instead of buying £200 worth of euros, you are now controlling a position of £6,000 worth of euros and profiting or losing from the price movements on that larger amount. I'm sure you can now see the appeal of Forex trading. Because each position is leveraged, it means you can make huge returns on a small amount of money, but it also means you can make equally as large losses. And then there's margin. So to leverage up your trades, you need to put down something called margin. In finance, margin is a goodwill down payment that the broker will ask for before you enter a trade. So in the scenario that I just gave, the margin you would put down is £200, and then the broker will give you the additional funds to leverage up your trade. The broker will also set a maintenance margin, which is the minimum amount of funds needed to stay in the trade. Typically, this will be lower than the margin. If your position falls in value and falls below this maintenance margin threshold, your online broker will ask you to deposit extra funds so that your margin is back up to the original £200. So how do Forex prices move? What are lots? And how do you actually make money? So the standard size for a lot is 100,000 units of the currency, and I think this is what you really need to understand when you're trading Forex. So like I said, the standard size for a lot is 100,000 units of the currency. You can also get mini, micro and nano lots equating to 10,000, 1,000 and 100 units of the currency respectively. So your broker may specify the quantity of the trade either in lots, while others may show the actual currency units you've bought. So a lot is just an amount of the currency that you're actually purchasing. So Forex prices then move in pips, or rather percentage interest points, and the value of one pip depends on the lot size, which makes sense, right? If you buy more units of the currency, or more lots, or a lot of a greater size, then the value of any price movement is going to be larger than if you had bought less. So let's say you bought one lot of Euro USD. This would mean that you were in control of 100,000 euros and the price movement that comes with that. The price of Euro USD right now is €1 to $1 spot 09794. The 4 on the end isn't actually the quote. It's kind of like milliseconds when we're talking about time. It's what moves the 4th decimal place. So that the true value of the quote currency is actually $1 spot 0979. Currency pairs are quoted to 4 decimal places, so 1 pip is the movement of the 4th decimal place. For example, if $1 spot 0979 increased to $1 spot 0980, this would mean that it's increased by 1 pip. You can now see on your screen how many pips are contained in each decimal place. As you can see here, a movement of the 4th decimal place is 1 pip, a movement of the 3rd decimal place is 10 pips, a movement of the 2nd decimal place is 100 pips, and a movement of the 1st decimal place is 1,000 pips. So the calculation of pip value for Euro USD would be 0.001 divided by the quote currency times by the lot size, which would actually equal around about 9.1 euros. So that means for every 4th decimal place movement on the Euro USD currency pair, if you'd bought one lot, which is 100,000 euros, you can expect your trade to either increase by 9 euros or decrease by 9 euros. And here is just some further details about the calculation of pip value for any lot size and for any amount of pip movement. Now, for the multi-million dollar question, can you actually make profit Forex trading? Well, the answer to this question is not simply can you make profit from Forex trading, because of course the answer is yes, of course you can make profit from Forex trading, but you can also make profit from gambling as well. So the crucial question is, can you consistently make profit with Forex trading? In other words, are there methods that people can use to consistently make profitable trades? Well, here are a few methods that so-called professional Forex traders use to beat the markets. First is resistance trading. Now, many online Forex traders watch Forex chart patterns closely for signals of resistance. Resistance on charts is simply where the price keeps either hitting a price floor or price ceiling and then jumping up or tumbling down each time. If resistance traders saw the price of Euro USD had hit 1.15 a few times and then bounced back down, it would signal a buying opportunity if the price then tanked beyond this threshold, as this would be breaking the resistance and reaching new highs. The second is a hedge. This is simply placing 2 opposite trades, for example a buy on the Euro USD and a sell on the Euro USD. This could be done with different lot sizes, but it basically just mitigates the risk of choosing one side and being completely wrong. With a hedge, you can always make sure that you're going to make some money either way, but whether that money is profit depends on how good the hedge is. The third is trend surfing. So many Forex traders believe there are trend patterns in Forex market charts or currency charts. So by trend surfing, you profit from these patterns by buying the pullback in a trend and then exiting the trade when you are out of this pullback, when the price has reached new heights. So for example, if it looks like the Euro USD has been trading in an upward trend for the last 2 hours, traders would look to buy at low points in that trend to make a profit. So there are many Forex strategies, and many people online claim to be making ridiculous sums through implementing them. However, like most, I still don't believe you can actually make money from Forex consistently, as the markets are so highly unpredictable and volatile. What's worse, if you are wrong with Forex and you are using leverage, you are amplifying your losses and may end up losing far more than you've put in. So if you want to trade Forex, I'd always recommend trading lot sizes that you can afford to lose if the trade goes against you.